1260. Kublai Khan stands in his newly conquered Chinese territories and makes a decision that will echo through 700 years of economic history. He's going to print money, not metal coins, not silk certificates, paper, backed by nothing but his word. And he's going to make it the only legal currency across the largest empire the world has ever seen. Marco Polo, watching this unfold, would later write with absolute amazement, "The Khan possesses the secret of the alchemists. He has the art of producing money, and for about 60 years, it worked. Better than anyone could have predicted." Paper currency fueled the greatest economic expansion the medieval world had ever witnessed. Trade exploded. Infrastructure boomed. The Mongol Empire became the most economically integrated territory in human history. Then it all came crashing down. By 1361, less than a century after its creation, Mongol paper money was worthless, completely worthless. Cities reverted to barter economies. The currency that had powered an empire for 3 generations couldn't buy a loaf of bread. What happened? How did the world's first successful fiat currency collapse so spectacularly? Here's the part that should terrify you. Every mistake the Mongols made, every warning sign they ignored, every mechanism that destroyed their monetary system is being repeated right now by every major economy on Earth. The Mongol paper currency experiment wasn't ancient history. It was a dress rehearsal. Before we talk about what the Mongols did, we need to understand why empires fail financially in the first place, because there's a pattern, a cycle that repeats across centuries. And once you see it, you can't unsee it. Let's start with conquest. An empire expands, takes new territory, seems unstoppable. But conquest is expensive, catastrophically expensive. You need armies, supplies, logistics. And the costs don't stop when you win. They accelerate. Now you have to garrison the territory, defend it, administer it, and all of that requires money. Lots of money, constantly flowing money. Traditional empires had 2 options for funding this: taxation or plunder. Tax your own people or loot your conquests. Both have hard limits. Tax too much and your own population rebels. You strangle the economy, kill the goose laying golden eggs. Tax revenues actually fall because there's less economic activity to tax. Plunder is even worse. It's a one-time score. You take the gold, the silver, the treasures, and then it's gone. You can't plunder the same city twice. Well, you can try, but you won't get much. So empires hit a wall, a financial wall, where the cost of maintaining territory exceeds the revenue it generates. And when that happens, they have 3 choices. Stop expanding, which usually means slow collapse because the system was built on growth. Debase the currency, reduce the metal content in coins. Make 1 gold coin go further by mixing it with copper, which causes inflation, which destroys trust in the currency, which causes economic chaos or collapse quickly, run out of money. Watch the army mutiny because you can't pay them. Watch provinces break away because you can't defend them. Rome did this multiple times. The denarius, Rome's silver coin, contained 95% silver under Augustus. By the time of Claudius II in 268 CE, it was less than 5%. They'd debased it into worthlessness, trying to pay for endless wars. The result? Inflation so severe that prices increased over 1,000% in a century. The economy fragmented into regional systems because nobody trusted imperial currency. The empire split. China, before the Mongols, same pattern. The Song dynasty issued paper money, starting around 1005, initially backed by metal reserves. But wars cost money, lots of money, so they printed more notes than they had reserves. Inflation exploded. By 1160, they had to reform the entire system because the currency had lost most of its value. Then hyperinflation kicked in again by 1166, just 6 years later. Why? Because the fundamental problem hadn't been solved. War still costs money, and when you're desperate, you print. The Jin dynasty, ruling northern China, followed the exact same path. Issued paper money in 1154, initially stable, then warfare with the Mongols intensified. Printing presses ran over time. Inflation destroyed the currency. This is the empire death spiral. Military pressure creates fiscal demands. Fiscal demands exceed revenue capacity. Currency, debasement, or overissuance attempts to bridge the gap. Inflation destroys trust. Economic collapse follows. Every empire faces this. The math is brutal and unforgiving. You can delay it, you can manage it carefully, but the underlying tension remains. Warfare costs money, and eventually you run out. The Mongols inherited this problem, conquered China, and took over an economy already traumatized by currency collapse. Multiple failed paper money systems, deep public distrust, fragmented regional currencies, and Kublai Khan looked at this mess and thought, I can fix this. I can create a paper currency system that actually works, that scales across my entire empire, that funds continued expansion without collapsing. He was right. For 60 years, he was absolutely right. Then he was catastrophically wrong. August 1260, Kublai Khan issues his first unified paper currency, the Gaokao made from mulberry bark, printed with woodblocks initially, later switched to bronze plates for durability. But here's what made it revolutionary. It wasn't backed by some vague promise. It was backed by silver. At a fixed exchange rate, you could take your paper money to designated exchange bureaus, 65 of them spread across the empire, and swap it for actual silver. Not 100%. You'd take a discount of 70 to 80% of face value. But the convertibility was real. It was guaranteed. The system was structured. This did something no previous paper currency had achieved. It created trust. Not trust in the paper itself. Trust in the system behind the paper. Trust that this wasn't another scam, another way for the government to steal purchasing power through printing. Marco Polo documented this obsessively because Europeans had never seen anything like it. He wrote, all his subjects receive it without hesitation, because wherever their business may call them, they can dispose of it again in the purchase of merchandise they may have occasion for. The currency worked everywhere. From Korea to Persia, same notes, same value, same acceptance. For a merchant, this was miraculous. No more carrying heavy metal across thousands of miles. No more worrying about regional currencies. No more exchange rate chaos. And Kublai backed this with serious enforcement. Counterfeiting was punishable by death, not prison, not fines. Death. Every note carried that warning printed right on it. The government treated its currency with deadly seriousness. Tax payments, accepted in paper currency. Official salaries, paid in paper currency. Military provisions, purchased with paper currency. The entire imperial administrative apparatus ran on this system. And it worked because the silver backing created discipline. The Mongols couldn't just print unlimited money. They needed silver reserves to back new issuance. This created a natural brake on the money supply, a built-in regulatory mechanism. But here's where it gets interesting. And by interesting, I mean terrifying. The Mongols issued 4 major currencies during the Yuan dynasty. Each one tracked a slow decay of monetary discipline. The Dantangsho, 1260 to 1286, first currency, full silver backing, relatively stable prices. First Zhuanzhou, 1287 to 1309, still backed by silver, but the backing weakened. The government started spending more than its reserves could support. Why? War. Always war. The conquest of the southern Song required massive military spending. Then, in 1273, Kublai issued a new series specifically to finance the final campaigns against the Song. The war ended in 1279. Total victory. The entire Chinese heartland unified under Mongol rule for the first time, but the financial discipline was already slipping. By 1276, just 16 years after launching the system, full silver convertibility ended. The notes were still nominally convertible, meaning in theory, you could exchange them. In practice, exchange bureaus often ran out of silver. Prices stayed relatively stable throughout this period. Inflation existed, but moderate, about 1.8% annually between 1290 and 1340, which by historical standards is remarkably good. The Mongols had figured out something sophisticated. You didn't need full backing as long as people believed in the system, as long as the government maintained fiscal discipline, as long as money supply growth remained moderate. Then 1310 happened. A complete pivot. The Mongols abandoned silver convertibility entirely. The currency became pure fiat, backed by nothing except government decree. Why? Same reason as always, war. But not external conquest this time. Internal conflict, civil wars between different factions of the Mongol ruling elite, power struggles, succession disputes, and civil war is expensive. More expensive than foreign conquest because you're fighting using the same resource base. You're not extracting wealth from new territories. You're burning through existing reserves. The government needed money. Lots of money, fast. And the printing press offered an easy solution. Just make more notes. Declare them legal tender. Force acceptance through law. For a while, even this worked. The system had built up enormous institutional trust, decades of stable currency. People were used to paper money. They accepted it. But the math was catching up. More money chasing the same goods. Classic inflation dynamics. Prices started rising. First slowly, then faster, then much faster. By 1345, the system was in crisis. Real, deep, structural crisis. A new currency was issued that year, the Jizing Sho. It was supposed to restore confidence. It didn't. People stopped trusting paper. They hoarded metal. They reverted to barter. The velocity of money, how fast currency circulates through the economy, collapsed. Everyone held onto real assets and dumped paper as fast as possible. The government responded by printing more, which made it worse, which made them print more still. Classic inflationary spiral. By 1361, paper money was functionally worthless. By 1368, when the Yuan dynasty fell, barter economies had returned across much of China. The most sophisticated monetary system the medieval world had ever seen destroyed itself in less than a century, and it destroyed itself through one mechanism, abandoning the constraints that made it work. The silver standard had provided discipline. Once that discipline was gone, once the government could print at will, the temptation to over-issue became irresistible, and over-issuance destroyed the currency. Let's look at the data, because the Yuan dynasty kept excellent records detailed enough that modern economists can reconstruct what happened with disturbing precision. Between 1260 and 1290, the early stable period, the Mongols conducted systematic censuses every 3 years. They knew exactly how much money was in circulation. They tracked prices across 12 major commodity categories: rice, millet, cotton, salt, silk, horses, gold, silver, tea. They built what modern economists call price indices, ways to measure inflation across the whole economy, and those indices show something fascinating. Inflation from 1260 to 1290 averaged 4.5% annually, higher than the later period from 1290 to 1340, which saw just 1.8%. Why? Because the early period involved massive military spending for the conquest of the Song. War creates instant demand for goods and services. Army provisions, equipment, construction, all of that drives prices up even with monetary discipline. But here's the key: the price increases stayed moderate, predictable. The economy could absorb them because money supply growth was constrained by silver reserves. Then look at the period from 1340 to 1355, the final phase before complete collapse. Inflation hit 11% annually, and that's probably understated because the government was manipulating the numbers by then. Researchers who've studied the actual issuance records found something damning. They can track exactly when the government started printing money without backing, and it correlates almost perfectly with military conflicts. Every spike in warfare, especially civil warfare, shows a corresponding spike in money issuance. The government would print to fund armies, prices would rise. Then they'd print more to compensate for the inflation they'd just created, which created more inflation. It's right there in the data. Clear as day. The fiscal pressure from warfare forced monetary expansion. Monetary expansion caused inflation. Inflation destroyed confidence. Loss of confidence accelerated the collapse. And here's where it gets even more interesting. Researchers tested whether other factors might explain the overissuance. Imperial grants, when the emperor gave lavish gifts to nobles and officials. Natural disasters, floods, droughts, famines that required emergency spending. Those factors barely registered. The data shows military pressure, particularly civil war, as the overwhelming driver of money overissuance. Everything else was noise. The Mongols had built a system that worked brilliantly under normal conditions. But normal conditions require fiscal discipline, and fiscal discipline becomes impossible during sustained military conflict. We can even track the geography of this collapse. Silver exchange bureaus were concentrated in major cities. Dadu, the capital, had 6 of them. Yangzhou, one of the wealthiest cities, had 3. But western and central China, much sparser coverage. This created regional variation in how fast the currency collapsed. Areas close to exchange bureaus, where people could still sometimes convert paper to silver, maintained trust longer. Remote areas where conversion was impossible abandoned paper money years earlier. By the 1350s, even in major cities, the exchange bureaus were empty, no silver left. The government had spent it all, used it to pay for wars, exported it west to pay mercenaries and buy loyalty. The institutional infrastructure of the currency remained, the laws, the enforcement, the administrative apparatus, but the substance was gone. An entire monetary system running on empty, sustained purely by legal compulsion and the fading momentum of past success. Marco Polo had compared Kublai to an alchemist who could create money from nothing, and he was right. But he missed the crucial detail. You can create money from nothing. You just can't create value from nothing. And eventually, everyone figures out the difference. 2008. The global financial system is collapsing. Banks are failing. Credit markets are frozen. The economy is in freefall. The Federal Reserve responds with an unprecedented intervention. They start buying treasury securities, mortgage-backed securities, corporate bonds. They create new bank reserves out of nothing and use them to purchase assets. Lots of assets. Between November 2008 and June 2010, the first round of quantitative easing, they inject $600 billion into the economy. Then another $600 billion. Then another $400 billion. By October 2014, the Fed's balance sheet has grown from around $800 billion to $4.5 trillion. $4.5 trillion created through monetary policy. This is not normal. This is not conventional monetary policy. Conventional policy adjusts interest rates, buy or sell short-term government bonds to nudge rates up or down. This is something different. This is the central bank creating money to purchase long-term assets at scale. It's the modern version of Kublai Khan's printing press. Just more sophisticated, more technical, wrapped in economic theory and institutional credibility, and just like the Mongol system, it worked. Initially, the economy stabilized. The financial system didn't collapse. Credit started flowing again. Crisis averted. The Fed promised this was temporary, a crisis intervention. Once things stabilized, they'd sell the assets back, shrink the balance sheet, return to normal. Didn't happen. By 2019, they tried quantitative tightening, started selling assets, reducing the money supply. The market crashed. They reversed course within months. Then, March 2020, COVID hits. The Fed launches QE4, another $700 billion, then more and more. The balance sheet peaks at nearly $9 trillion. $9 trillion. More than the entire GDP of every country except the US and China. Created through monetary policy, injected into the economy through asset purchases. Now, here's where the Mongol parallel becomes impossible to ignore. The Yuan dynasty moved through 3 phases. Full silver backing, nominal silver backing, pure fiat with no backing. Each phase represented a weakening of monetary constraints. Each phase ended because fiscal pressure, specifically from warfare, forced the government to abandon discipline. The modern United States, same trajectory. 1971. Nixon ends gold convertibility. The dollar becomes pure fiat, no metal backing. Value based purely on trust in U.S. economic and military power. For decades, this worked. The dollar is the global reserve currency. Everybody needs dollars for international trade, particularly oil trade. This creates constant demand, supports the dollar's value even without metal backing. But here's the constraint that replaces metal backing: fiscal discipline, or at least the perception of fiscal discipline. As long as the government doesn't massively overissue currency, as long as inflation stays moderate, the system works. 2008 breaks this. When the crisis hits, the choice is between financial collapse and unprecedented monetary expansion. They choose expansion, they choose quantitative easing. They choose to create trillions in new money. And just like the Mongols financing the Southern Song conquest, it worked. The crisis is managed, the system survives, but the constraint is gone. Because once you demonstrate that massive monetary expansion is possible, is acceptable, is politically necessary during a crisis, you've changed the rules. You've shown that the discipline was always optional. 2020 proves this. COVID hits, lockdowns crater the economy. The response? Print. Trillions. Handed directly to households and businesses. Combined with quantitative easing, the fastest, largest monetary expansion in peacetime history. And now, 2022 through 2023, inflation returns. Not hyperinflation, but enough to matter. Consumer prices rising at rates not seen in 40 years. The value of money, of savings, eroding month by month, just like the Yuan dynasty in the 1340s. Not complete collapse, but the warning signs. The system straining, prices rising faster than they should, trust beginning to erode. The Federal Reserve responds by raising interest rates, trying to tighten, trying to reduce inflation. But here's the trap. The government is now so deeply in debt, over $34 trillion, that higher interest rates mean massively higher debt servicing costs. Higher rates to fight inflation make the fiscal situation worse, which creates pressure to keep rates low, which allows inflation to persist. It's a bind, a trap created by decades of expanding money supply to fund government operations. And what drives this? Same thing that drove the Mongol collapse. Military spending? Not exclusively, but look at the numbers. Between 2001 and 2025, Pentagon spending totaled over $14 trillion. Over $14 trillion, much of it financed through debt. Debt that required expanding the money supply, debt that now constrains monetary policy. The wars in Iraq and Afghanistan cost over $2 trillion directly. Add in long-term veterans costs, interest on war debt, and the costs of war project at Brown University estimates over $8 trillion total. That's not ancient history. That's money created, spent, and still being paid for through expanding the monetary base, through quantitative easing, through mechanisms that look different from a Mongol printing press but function identically. And it's not stopping. Defense spending keeps growing, from $600 billion annually to $800 billion. Requests for $900 billion, $1 trillion, justified by threats, by strategic competition, by the same logic that kept Mongol armies in the field. Meanwhile, the velocity of money is falling. People and institutions are hoarding cash, not spending, not trusting. Same behavior seen in the Yuan dynasty's final decades. When confidence erodes, money stops circulating, which makes the economy sluggish, which creates pressure to print more money to compensate. We're following the script. Phase 1, backed by real constraints. Phase 2, nominally backed constraints weakening. Phase 3, pure fiat with expanding supply driven by fiscal necessity. The Mongols completed this cycle in about a century, started 1260 with full silver backing, ended 1368 with worthless paper and barter economies. The modern system started in 1971 with the end of gold backing. We're now 54 years in, halfway through the Mongol timeline, and we're already seeing the warning signs they ignored. Here's what the Mongol experiment teaches us about fiat currency. And this is the part nobody in power wants to hear. Every fiat currency system works, until it doesn't. And the transition from working to not working is determined by one variable: fiscal discipline. Or more specifically, the ability to maintain fiscal discipline in the face of military pressure. The Mongols proved this. They created the most sophisticated monetary system the medieval world had ever seen, backed it with silver, built institutional infrastructure, enforced it rigorously, made it work across the largest empire in history. And it worked. For 60 years, it worked brilliantly. Then war happened. Not external conquest, internal conflict, civil wars, succession struggles, the kind of military spending that doesn't generate new territory or new tax revenue, that just burns resources. And when that military pressure became too intense, the government made a choice: keep the fiscal discipline and lose the war, or abandon the discipline and win the war but risk the currency. They chose the currency. They chose to print. They chose short-term survival over long-term stability. And within 50 years, the currency was worthless. The dynasty fell. The system collapsed so completely that China wouldn't use paper money again for centuries. The trauma was that deep. We are running the exact same experiment, just with more zeros, more sophisticated mechanisms, more technical language to obscure what's happening. But the fundamentals are identical. Fiat currency, government with printing authority, fiscal pressure from military spending, gradual erosion of discipline, expanding money supply to bridge the gap between spending and revenue. The Yuan dynasty moved from 4.5% inflation early to 1.8% inflation mid-period to 11% inflation late, then collapse. The United States, 2008 to 2020. Low inflation, QE worked without triggering price increases. 2021 to 2023, inflation returns, 7%, 9%, highest in decades. We're in the late stage. The inflation is back. The discipline is eroding. The fiscal pressures are intensifying. And here's the question nobody wants to answer. What happens when the next crisis hits? The next pandemic, the next financial collapse, the next war? What's the response? More QE, more money printing, more stimulus. At what point does the system break? At what point does inflation stop being manageable and start being catastrophic? At what point do people lose faith in the currency itself? The Mongols couldn't answer that question. They didn't see the collapse coming until it was too late. By the time the warning signs were obvious, the mechanisms were already locked in. The printing had created expectations. Inflation had created political pressure. Stopping would have been economically devastating. So they kept going, kept printing, kept inflating, until the whole system imploded. We have better data than they did, better models, better understanding of monetary economics. But we're facing the same fundamental constraint. You cannot print unlimited money without consequences. And those consequences arrive exactly when fiscal discipline becomes impossible to maintain. The Mongol paper currency experiment wasn't a failure of technology. It wasn't a failure of implementation. It was a failure of constraints. A system designed to work within limits that became politically impossible to enforce. And that's the trap, because fiat currency offers governments an impossible temptation. The ability to fund operations without immediate taxation, to defer costs, to expand spending without political pain, until the monetary inflation creates its own pain, until prices rise, until confidence erodes. Until the deferred costs arrive all at once in a crisis nobody can manage. The Mongols proved you can run a fiat currency system successfully for decades. You can create real prosperity, real economic growth, real improvement in people's lives. But you can't run it forever, not without discipline, not when war costs money and printing presses are available, not when the choice is between military defeat and monetary expansion. They made their choice, we're making ours. The mechanisms are different. The technology is more advanced. The economic theories are more sophisticated, but the outcome, that's still being written. And the Mongol experiment suggests we might not like how this story ends. The collapse of Mongol paper money revealed a hard truth. States can create currency, but they can't force confidence forever. As empires fell, the responsibility for funding war didn't disappear. It shifted. In the 19th century, private banks stepped in to solve the problem governments could no longer control. That shift becomes clear in the Crimean War. If you enjoyed this deep dive into monetary history and its modern implications, check out the next video where we explore the banking coup that funded the Crimean War. Don't forget to subscribe and like the video. These patterns repeat, and understanding them might be the only way to break the cycle. Thanks for watching.